chat about deal structure. This is not a piece of real estate. This is an area where there can be some creative solutions to bridging a gap or coming together on how the proceeds are going to be paid out. What is a business acquisition sale? What does that transaction look like?
That's a great question. So typically there's two types of transactions. It's either an asset purchase transaction or a share purchase transaction. An asset purchase transaction is typically considered more buyer friendly because they come in and they're only buying the assets of the business. Typically they have their own company or business set up, and so those assets then just get acquired and then ownership transfers into their existing company. Share purchase or stock purchase is considered seller friendly, and there's two primary reasons for that. When a buyer buys the shares of the company, they buy the whole thing, which is assets plus any potential liabilities that the company has. So from a seller's perspective, it's a way to walk away free and clear. You're not left holding a company now that you still hold the shares of that doesn't have any assets because it's now been sold off. And also on the Canadian side, from a seller's perspective, it allows you to take advantage of your lifetime capital gains exemption. So that exemption is only eligible if you're selling shares, not assets.
Right. Yeah, that's a very compelling reason to want a share sale.
Yeah, saving some taxes.
Yeah, absolutely. Strong motivator. And so what does it look like as far as funds at closing? What can a business owner expect in terms of, do they get 100% of it on the day of closing, or what does that compilation look like?
Yeah, I would say that's becoming increasingly rare in the market than it used to be. But yeah, ideally from the seller's perspective, it's take it as is. All the cash is paid at closing. Money hits your account. You hand over the keys to the business and you walk away. That's best case scenario for the seller. But typically the buyer wants to manage some of that risk post-closing. So there could be multiple ways to do that. And also, and more importantly, where there's a gap between what you think the business is worth as a seller and what a potential buyer thinks the business is worth, there's a couple other mechanisms that can be implemented to help bridge that gap.
And when you say risk of the buyer in managing that risk, what is the risk that buyers are perceiving? Because if this is my company and I'm running my company and I'm like, everything's great.
It's perfect.
Yeah. It's going to perform the same way for you than it did for me.
Yeah.
Why are you worried? But what might be some of those things that the buyers are concerned about?
Yeah, always tricky stepping into a seller's shoes, particularly if it's been something that the seller's been running for a number of years. If the buyer isn't from the industry, isn't familiar with operations, if it's a first-time buyer that's just looking to buy a business for the first time, if it's a private equity fund that's looking to add a business to their portfolio, things like that, where they're not just necessarily right away stepping into the operator's shoes, it's important to manage some of the risks of, will those vendors and customers and all those relationships that have been fostered by the existing owner continue and maintain in the same way post-closing? Will all the employees stay, or are they very loyal and sticky to the business operator? What happens if a bunch of them leave? What does that do to the business and impact its ability to maintain, going as a going concern? So I think from the buyer side, there's always a bit of hesitancy to just, pay full cash at closing and then hope for the best when it closes.
There's a lot of what ifs in there.
A lot of what ifs.
Okay, so what might be some of those ways that a buyer will try and share the risk or protect themselves in that transaction?
Yeah, so the two most common ways are a seller finance transaction, where the seller funds a portion of their buyout. And that's kind of weird because now you're paying for your own exit. But the way it works is, the buyer will agree to a purchase price and pay that, but they won't pay that full amount up front, as a way of mitigating, what they're paying right off the bat. And then the seller pays for a portion of the purchase price themselves, and then gets, some sort of promissory note in place with the business, and then that is paid out over a period of time. So
they're not giving the buyer cash.
No.
They're just deferring what they will receive for the business
over a period of time.
Over a period of time.
Yeah, and what that allows the buyer to do is get into the business, make sure that they're very comfortable with it, ramp it up, make sure it's operating the way it was pre-closing, so that there's enough revenue and cash flow to then finance or fund the rest of the seller financing. And from the seller's perspective, it's a way to still facilitate your exit, earn probably some interest on the piece that you are now lending to the buyer.
Could actually get a bit more if they calculate the interest and
absolutely
look at it that way as well.
And they should get a little bit more, because now they're sharing in that risk and helping protect protect some of the buyer's potential or perceived downside.
And can we talk a little bit about earnout, because that comes up from time to time as well?
Yes.
Tell us about earnouts.
Yeah, so earnout would be the second way to bridge that gap between what a seller thinks the business is worth and what a buyer is willing to pay for it. And so the way an earnout works is you're paid a certain portion of the purchase price up front. And, we've also seen it where it's 3-tiered, where you get a certain portion paid up front, a portion is seller financed, and then you layer the earnout. But typically it's purchase price and then earnout. And then the way that works is that you're able to earn more and get more for your business if certain performance metrics or financial thresholds are met through the earnout period, which is typically 1, 2, or 3 years.
Okay, so let's say my company's doing really well and I want to be paid for that success, and I want to be paid for, the sales that maybe we've set up the sales, and the future is looking rosy.
Yeah.
But it does make sense for us to sell the business right now. The earnout allows you to still get some gain on future.
Yeah, so some businesses, if you have a pipeline of projects or a pipeline of sales lined up, you want to be compensated for that. So if that's something the buyer's not willing to pay for up front because those projects haven't been completed or those sales haven't been crystallized, an earnout is a way for the seller to then play in the upside or the potential upside that they see in the business based on what they've set it up for leading into the closing date.